This last week was absolutely brutal. It does not matter if you held crypto, and it does not matter if you held stocks, and it's almost not mattering if you're holding real estate. Everything happened to get demolished over the last week. It doesn't matter if you held NASDAQ stocks, S&P stock, Dow Jones stocks, Bitcoin, Cardano, Ethereum, Algorand, it does not matter. And it seems like wherever you're holding real estate, the prices of real estate are starting to cool off. Everyone thinks that inflation might have peaked somewhere around June, and the market started making a really nice rebound. And over the last 2 months, it seems like whatever gains we made, any return on our investments were given back into thin air, gone. Why did everything go down last week? And again, I don't give an F if you invest in stocks, crypto, or real estate. This is a video for everybody. Last week on Friday, there's a guy called Jerome Powell. He heads a service called the Federal Reserve Bank. The Federal Reserve Bank is not a bank that's controlled by the federal government. However, the federal government definitely does have some sway in what happens with the Federal Reserve. The Federal Reserve meets 8 times a year. 8 times a year, they control one of 2 things. They control the interest rates and they control their books. Their books is just how much assets they have. As they buy assets from the economy, they put money into the economy. This is referred to the money printer. They don't actually print money, but that's how it goes. They buy assets off the open market, they put money into the open market. When they want to reduce their balance sheets, they then sell or don't renew those assets, and money now leaves the economy. They also control interest rates. The interest rate is called the Federal Funds Overnight Rate. And the Federal Funds Overnight Rate is just the rate that banks use to lend to each other. And when I'm gonna say banks, let's talk about the highest banks. Let's talk about the Citibanks, the Chases, the Bank of America. Let's talk about the mega banks of the country. So Jerome Powell, and I'm gonna get back to this in just a moment, you gotta hear the rest of it. So Jerome Powell, he goes on Friday and he makes a speech at something called the Jackson Hole Economic Summit. He does the closing speech. And Jerome Powell goes on and he basically says, hey, the last 2 meetings that we had, we have 8, the last 2 meetings that we have, we raised the interest rates by 75 basis points. 75 basis points means 0.75% for anybody who doesn't know. 100 basis points, 1%, 25 basis points, 0.25%. 75 basis points, 0.75%. So the last 2 meetings, he raised it by 0.75%. And right now, the Federal Open Market Committee, the Federal Funds Overnight Rate is 2.25 to 2.5%. Fantastic. So everyone thought that in the next meeting, Jerome Powell will be raising by 50 basis points, which is 0.5%. He basically made it very, very clear, no, I will probably be raising by 75 basis points, and I'm gonna do whatever I have to do to curb inflation. We need to reduce inflation by all necessary means because inflation is ruining our economy, inflation is ruining our lives, it's just ruining it slowly. So we need to nip this in the bud, so to speak. So on Friday, when he goes on, everyone's like, yo, he just rugged the market. We thought he's going to be raising by 50 basis points, but he's raising by 75 basis points. The problem is people are just not listening. We've been talking about this on this show for quite a long time because on this show, unlike to the moon cheerleaders, we actually do talk about economics for whoever's been listening. And I appreciate all of my subscribers. My videos seem not to do so well because I talk about actual, factual things that's happening in the economy. Pretty sick, right? Okay, so now you have this Jerome Powell guy who comes out. He makes this speech on Friday and he just reiterates what he's gonna do. So now Jerome Powell reiterates that he's gonna do whatever he has to do to curb inflation. So the question is, why does this inflation affect the banks? How do those banks affect our actual life and our investing life? And where is this going to stop or where is this going to continue to? So first of all, let's talk about how this affects us. Jerome Powell and the Federal Reserve, they set this Federal Open Market Committee Federal Overnight Rate. And that rate is the rate that the huge banks borrow against each other. those huge banks, the biggest banks, then lend money to the largest banks. So the biggest banks, then you have right under them the largest banks. Think about like primo uno, right? Number one, grade A, and now think about grade B plus. And they lend to other banks, and they usually lend at prime rate. What exactly is prime rate? Whatever the Federal Open Market Committee, the Federal Overnight Fund rate is, you add approximately 3%. This is a rule of thumb. This is not a fact, but approximately. So, for example, during coronavirus, our federal funds rate was at 0%. That's why a lot of us were getting mortgages. A lot of us were paying loans at what percent? Approximately 3%, right? Remember, you guys are paying 3%. Where does the money come from? Well, it's practically free to get money for the biggest banks, right? The largest banks. And then they lend to the big banks. So now you have the prime rates. And those biggest banks then lend prime plus to the mid banks, smaller banks, so on and so forth, until it trickles down to people like you, to people like me. And that's how this affects us. How does it affect you in investing? Because you're like, okay, Adam, well, I'm paying 3% for my mortgage. I'm paying 6% for my mortgage. I got it. It's just more expensive. But while you're opening up a mortgage for $100,000, $500,000, $1 million, you have huge mega cap corporations that are borrowing tens of millions, hundreds of millions, and billions of dollars. So the difference of a 1% on $100 million is $1 million. But if you're paying 5% on $100 million, you're paying $5 million. Now, at the end of the day, this can be multiplied and this can be subtracted, but you get the gist of it. There's something called a earnings recession. What exactly is an earnings? Well, if you're a profitable company, you have something called a PE ratio, which is your price to earnings ratio. Your earnings go down if you have debt and you borrow money. And believe it or not, huge corporations have debt. Amazon has debt, Ford has debt, Tesla not so much debt, Palantir not so much debt, but a lot of huge companies have debt. The legacy companies, like all of your cruise lines, like all of your airlines, all of them have massive amounts of debt. So at the end of the day, as the interest rate is going up, well, the big banks are lending at prime or prime plus, which means that these mega corporations have to pay so much more money. Because they have to pay so much more money, this goes on their balance sheet and their PE ratios are subtracted. Because the PE ratio is a multiple, depending on what industry you are, of how much you're actually earning. But the earnings is reduced by the amount of money you have to pay on the money that you're borrowing for expansion, employment, research and development, so on and so forth. So now we understand why the market tanked. Now we understand what the Federal Reserve actually does. Now we understand how the Federal Reserve actually affects our life. And we understand how the Federal Reserve affects the corporation's earnings, which affects our investment. For anybody that's wondering, how does this affect cryptocurrency? Cryptocurrency is now just a sub-asset of the tech sector of the NASDAQ. That's it. And I explained this many times before. So when I'm talking about NASDAQ, interchange that with cryptocurrency. Anytime I say NASDAQ, it can always be associated with cryptocurrency to an extent. It's like an 80% clone right now with 20% differentiation. So everything I'm saying also has to do with cryptocurrency. Now you have this federal funds rate. The current federal funds rate, as I said, is 2.25% to 2.5%. In the last meeting that Jerome Powell had, the Federal Open Market Committee had, he calls this a neutral rate. What does neutral rate mean? A neutral rate means the rate of the federal funds rate that can combat inflation in not a negative and not a positive way. It's called a neutral rate, which means if we want inflation to be 2 to 2.5% and our interest rate is 2 to 2.5%, well, that's a neutral rate. That's an equilibrium, plus or minus. Great. So when he said that, people are like, okay, he's not going to be raising interest rates. There's no point. We got a neutral rate. The problem is The interest rates started here, while inflation started here. So inflation is slowly starting to go down, and interest rates are slowly starting to come up. If this was a neutral rate and we had inflation here, we would be all good. The problem is inflation is still here, and you have a huge gap, a huge disparity between inflation and interest rates. So Jerome Powell must keep raising interest rates, and he's being smart about it. I've been saying it on this channel for quite a while. If he's smart, he will continue the good fight against inflation. So now you're gonna say, Adam, that's great, but what happens now? When does this stop? And is there any end in sight? Good question. And for anybody that's still here watching this really boring video that is super important and packed with knowledge, please give me the likes, shares, and subscribe, because I don't think I'm gonna get more than 200-300 views on this video on any one of my channels. So I have this list right here. I share this with my Patreons all the time, and I'll just give you guys what I think is gonna happen. I wrote this in the last meeting. It's right here. This is the paper, okay? So I'm not just making this up. I believe that in September, he's going to be raising by 75 basis points, which brings us to a 3 to 3.25 rate. In November, it's going to be 50 to 75 basis points, which brings us to a 3.5 to 4%. In December, we have another meeting, which is going to bring us plus 50 basis points, which brings us to 4 to 4.5. In January, I believe it's going to be somewhere 25 basis points, which brings us to 4.25 or 4.75. And then in March, I believe he's also going to do a 25 basis points, which brings us to 4.5 to 5% for the federal funds rate. So for anybody that's worried, hey, Adam, how much are mortgages going to go up if you have real estate? Well, if the federal funds rate is going to be 5%, the big banks are lending at prime, you're probably going to be looking at around an 8% mortgage, somewhere there, 8.5, 7.5, plus or minus. What happens after this and what affects the economy? After the meeting in March, I believe that we're no longer going to be raising interest rates. I believe that interest rates are then going to start getting reduced, like there's going to be a reduction. I believe the second half of 2023 is going to be good for crypto. It's going to be good for stocks. I believe when we stop raising the interest rate, this is when the market is going to start rallying. I also believe once we start raising the interest rates less than 75 basis points, the stock market is also going to start rallying. Before I go any further, I'm not a financial advisor. This is purely entertainment and education at best. I'm jam-packing this video with tons of economic knowledge, both micro and macro, and a lot of boring terminology that I find absolutely fascinating. And if you don't know everything that I'm talking about in this video, it's okay. That's why I'm making this video, but it's very good for you to do your own due diligence and do your own research on the topics that I'm talking about today, because these topics is what actually drives both micro, macro economics and ultimately puts money in your pocket, puts money in your family's pocket. It's not these morons who are screaming to the moon just to get your clicks, your likes, so on and so forth. So I could be completely wrong. And everything that I'm saying is contingent on a lot of other things, because you see the economy, it doesn't just go on a straight line. The economy has road bumps, ups, downs, so on and so forth. And somebody can throw a ratchet into the mix, right? So what causes the interest rates and what affects inflation? Why do I think, like, what's my thesis? I could be right, I could be wrong, but I always back what I'm saying with a thesis. I have a reason for every number that I just put out there. So right now, there's a couple of key dates that you want to look at. There's a few reports that actually guide you with what's happening with the economy. There's many different reports. Right now, we're going to be looking at very interesting reports. You have the jobs report, which comes out September 2nd. The jobs report is the first week of every single month. Why is the jobs report so important right now? The jobs report is near record highs, which means there's super amounts of employment, which means that there's more jobs than there are people looking for jobs. Now that number is starting to come down. Before it was 1.9 jobs for every one person looking. It came down to like 1.8 jobs for every person looking. The Federal Reserve themselves says that we need unemployment to go up, which means we need jobs to go down. If the jobs report is strong, the Federal Open Market Committee can keep raising interest rates as aggressively as they want. I believe that the jobs report is going to start getting reduced. And that's why I believe, besides for the jobs report plus inflation is going to keep going down, in my opinion. I'll explain that in a moment. That's why the Federal Open Market Committee is not going to be raising 75 basis points the meeting after this one. So the jobs report comes out September 2nd. Definitely watch it on my channel. It's going to be this Friday. I'll be filming it live. September 13th, there's going to be the CPI, Consumer Price Index, both for everything and core. The Consumer Price Index comes out once a month. The Consumer Price Index actually comes out before the Federal Open Market Committee. No matter what happens, we are going to get 75 basis points in this next meeting. That's my opinion. But if the CPI is going to come down to a number of, let's say, 8%. So last meeting we have 8.5, the meeting before that 9.1. Jerome Powell keeps saying, look, 1 month of inflation going down doesn't solve anything, because we've had that a couple of months back where inflation went down and then it went through the freaking roof. We need a few consistent months. So if the CPI went down from 9.1 to 8.5 last month, and this month, I'm just giving you an example, the 8.5 can go down to, say, 8%. The next meeting for the Federal Open Market Committee, they're going to be raising by 75 basis points. However, after that, there's no meeting in October. So if CPI goes down again, say somewhere in the 7s, well, then in November, they're going to stop raising by 75 basis points, and the same thing in December, because the interest rates will keep going down. That's where I'm going with this. This is my train of thought. You guys can screenshot this and make fun of me later on, but I'm just giving you guys the way I think, right or wrong. And I'm not saying I'm right. I'm just giving you my thoughts. September 14th is something called the PPI. The PPI stands for the Producer Price Index. Think about it very, very simple. CPI is consumer, you guys, me, whatever we're buying and in the market. Producer Price Index is the wholesaler. Before it gets to the consumer, it's from the producer. So if the PPI keeps going down, that's a precursor to what's going to happen in the CPI. The last PPI that we had was also great indicators, the one last month. I covered it on my channel. Most people don't watch those videos. So CPI is going down from 9.1 to 8.5. PPI also went down, and the wholesalers get the numbers before the consumers get the numbers. So because the PPI went down, that's why I think this month's CPI report is also going to go down, and that's why I think the next meeting, not this meeting, the meeting after that, we're only going to get 50 basis points instead of 75. Now, September 16th, we're going to get preliminary numbers for something called the Consumer Sentiment Index. The Consumer Sentiment Index is how people feel in the economy, how they feel in the long term, how they feel in the midterm, and how they feel right now. As the consumer sentiment goes up, this is regular people in the economy feeling how the economy is. As it's going down, that means the economy is getting bad. As it's going up, the sentiment, that means, hey, things around the economy are starting to get better. This is not pushed by the government. This is regular people that they're asking in the streets, right? Like, how do you feel about life? And they keep perceiving that inflation is actually going down, not up, down. But for the longest time, they thought inflation is going up, right? So now we have the CPI, inflation going down. We have the PPI, which is the producer inflation going down. And then we have consumer sentiment going up. So CPI is a lagging indicator. What happened a month ago, the interest rates. The PPI lagging indicator, but less lagging indicator because it's a forward moving indicator for the CPI. And then the consumer index, sentiment index, is a more of right now how people are feeling, and they're all interconnected. And then the Federal Open Market Committee is going to be meeting on September 21st. After the 75 basis points rate hike in September 21st, there's no meeting in October. There is a meeting in November 2nd. And interestingly enough, the CPI data for November is actually coming after the FOMC meeting. It's very, very interesting what's going to happen and how everything works out. So now I interconnected everything, and now people are going to say, Adam, why else do you think that inflation is going down? The reason why I think inflation is going down is because inflation right now is disproportionately affected by energy. To track energy, I track gas prices. I track gas prices by crude oil. This is called a commodity. Crude oil peaked at around $124 a barrel somewhere in June 9th, June 10th. Currently, crude oil is trading at somewhere between $85 and $90 a barrel. The gas prices, when I started tracking gas, the actual gas at the pumps, which is your crude oil minus distribution, production, delivery, so on and so forth, the price of gas right now is $3.85. When I started tracking it, it was $5.01. If you put the numbers down, that's like a 23% reduction in gas. Now, right now, gas accounts for around 35% of the CPI, while food accounts for 10% of the CPI. Food should be accounting for like 14% of the CPI, while gas should be accounting for around 8% of the CPI, which means that gas is disproportionately higher for the CPI. And when I say gas, I mean energy, I apologize. So as energy prices are gonna go down, this is gonna affect the CPI. This is gonna affect inflation rates. That's why I think inflation is going down. Also, a lot of people are like, hey, Biden, national petroleum reserves. You know, you guys are saying this stupid shit and it drives me crazy, right? Biden released at the end of March, he said for 6 months, I will be releasing 1 million barrels from the petroleum reserves, 1 million barrels a day, which is huge. But America consumes 20 million barrels a day. So if he's releasing 1 out of 20, that's a 5% reduction in gas, right? Oil. If gas prices at the pump went down 22, 23%, and Biden releases 5% of how much gas we consume in a day, how is it possible that the gas actually is coming down 22, 23%? Where does the other 17, 18% come from? Where? Guys, I'm not trying to be political here, but it's like, let's just be honest here. The price of gas is going down. Yes, the National Petroleum Reserves has something to do with it, but it's not the be-all, end-all of why inflation is going down, why crude oil is going down, why gas prices are going down. It's contributing, but it's not the end factor. There's a lot more things happening in the economy. I just hate when I bring this up and people are like, oh, the National Petroleum Reserves, but people don't even do their research. And then a lot of National Petroleum Reserves is being sent to other countries. But that 1 million barrels a day, that's the United States that's being released in the United States, you know, for United States consumption, but it's only 5% of how much we consume. Meanwhile, gas prices are down around 22, 23%. So it doesn't really make sense what you guys are saying, and people are just full of shit, unfortunately. Guys, thank you so much. I hope you enjoyed this video. I know it was jam-packed with a lot of goodies, and please, for whoever's still here, give me the like, shares, and subscribe. And if you guys want to trade some stocks, I do have a link down below for Webull. Webull is actually fantastic. You're gonna get 12 free shares, 12 free partial shares. The last partial shares I got was like Snapchat, Apple, and a couple of other really cool companies. Yeah, I got a couple of partial shares of Apple. It's pretty cool. And that gives you some fantastic charts that you can use. You could also trade with cryptocurrency, so on and so forth. It's really dope. Guys, thank you so much. Give me the likes, give me the shares, give me the subscribe. The Berg is out.